Hello and welcome. In this lecture video, I'm going to provide an overview of managerial accounting. I'll compare and contrast managerial and financial accounting. I'll also talk about planning and control issues within managerial accounting and performance reports and begin to introduce some key cost terms and concepts associated with managerial accounting. So if we think back to Accounting 101, Accounting 101 was focused on financial accounting. And you think about some of the topics that we covered in Accounting 101, we spent a lot of time on journal entries. And journal entries are the way by which we record transactions within the organization. We'll spend a lot of time on journal entries. We spent a lot of time on how to generate and create general purpose financial statements. So we talked about how we create journal entries, how we do journal entries, and then how we post those journal entries to the general ledger, and then how we use the information from the general ledger to then generate a trial balance, and then eventually to create an income statement and a statement of owner's equity, and then the balance sheet. So we focused on recording transactions and the generation of financial statements for external users. That's what we focused on in financial accounting. In managerial accounting, on the other hand, we're talking about using accounting and financial information to make decisions within the organization. So for example, how many units or how much sales would we have to generate in order to cover all of our costs to break even? And so the thing that I really like about managerial accounting is that the information that you're going to learn in managerial accounting is going to be applicable even if you never want to become an accountant. Even if you want to just run your own bike store, open up a bike store in downtown Fredericksburg, or just a small clothing shop, or any kind of store like that, you need to know the concepts that we talk about in managerial accounting. They will help you in running your own small business, okay? Managerial accounting is probably my favorite to teach, okay? I really like the business decision aspect of managerial accounting, and I also like how we discuss how incentives can influence the behavior of employees. And that's another key topic that we talk about in managerial accounting. So kind of touching on these two bullets that I have right over here, managerial accounting provides financial and non-financial information for managers of an organization. Financial accounting, as I was just talking about, is focused on the generation of general purpose financial statements for external users. So this table does a nice job of comparing and contrasting financial and managerial accounting. So we talk about users and decision makers. Financial accounting, we're talking about external users, so investors, creditors, and regulators. Managerial accounting, we're talking about managers, employees within the organization, so internal to the organization. The purpose of information with financial accounting, help external users to make investment decisions or any other kind of decisions associated with regulation or credit decisions. Should we loan money to this company? Purpose of information with managerial accounting, help managers inside the organization with planning and control and decision making. In terms of our flexibility of practice with financial accounting, we have to follow generally our GAAP. And when we look at with managerial accounting, there is some flexibility with reference to GAAP. Okay. In terms of the timeliness, this tends to be lagging information. It's after the audit. With managerial accounting, we're looking for more forward-thinking information, and it can be done quickly. We might be able to pull the information pretty quickly from our internal information systems. In terms of the time dimension, as I was just mentioning, this is focused on historical information. We're reporting, for example, with the income statement, here's our revenues, expenses, and income for the prior period. So we're saying this is what happened in the past. With managerial accounting, though, because it's focused on making business decisions, we need to look at not just historical information, but also more forward-thinking information. Okay? So we look at the focus of our information in terms of financial accounting. We're looking at the entire organization. Okay? When we're looking at managerial accounting, on the other hand, we're not just focused on the entire organization, but we might be looking at how did one division do in comparison to another division. Okay? In terms of the nature of the information, we're talking strictly monetary information. So we're reporting revenues, expenses, income in terms of currency, dollars, for example. But with managerial accounting, it's a lot of monetary information, but we could also have some non-monetary information. And let me give you an example. One of the things that we might be looking at in terms of managerial accounting would be customer satisfaction. Customer satisfaction is non-monetary, but customer satisfaction is important to look at because it is a leading indicator of financial performance. And let me explain that. If we see that customer satisfaction, we do some surveys of our customers, and we see that they're happy, what do you think this means for sales in the future? It's probably a good sign, right? We have happy customers. That means that we might have more sales or more repeat customers in the future. But on the other hand, if we see that customer satisfaction is poor, what do you think this means for sales and naturally flows down to income for the future? It's probably a bad sign. We have unhappy customers. What does that mean for sales in the future? It means that maybe we have fewer sales in the future, and it could also mean that we have fewer repeat customers. Okay? Another key aspect about managerial accounting is planning and control. And so when we're talking about planning, we're talking about setting strategic goals. Those could be long or short-term goals. An example of planning would be setting the annual budget. And I used to be a financial analyst. I think I've mentioned that a few times now. And a financial analyst is one of the specific job roles that fall under the umbrella term management accountant. So I was a management accountant in my industry experience. And I used to have to do budgets, and budgets took a very long time. We would start the budget process in August for the next year. And so budgets is an example of planning. It's a financial plan. And what we would do is we would set our financial plan, and then we would monitor how well are we doing currently against our budget. So we would look at, for example, are our expenses higher or lower, our actual expenses higher or lower than budget. If they're higher, that's unfavorable. If they're lower, that's favorable. We could also look at revenues. Are revenues higher or lower than budget? If they're higher, that's favorable. Lower, unfavorable. Then we would have some feedback. And maybe what we'd have to do is say, all right, maybe we have to adjust the budget. Due to some unforeseen circumstances, maybe the budget was unrealistically high. So now we have to adjust it. Okay? Or maybe what we need to do is think about a management change. The manager is not performing very well, and so we need a new manager. So that idea of feedback and then control mechanisms to help us decide how to improve our performance as measured against the budget. Okay? One aspect that helped us do that were performance reports. Okay? Performance reports helped us to compare actual performance to budgeted performance. All right. So performance reports help us compare actual performance to budgeted performance. And a big part of my job as a financial analyst was to generate performance reports and then investigate variances. So if we look on this next page, we have an example performance report right here, where we say we have our production, our actual production is 100,000 units. We anticipated that having 100,000 units. Then we have our materials cost of 140,000, budgeted 125, and then we can see $15,000, right? And that would be, if we look at this in terms of cost, our actual cost is higher than our budgeted. That's going to be an unfavorable variance. U for unfavorable. Labor costs, on the other hand, actual 145, budgeted 150. Actual labor costs are lower than budgeted. Expenses are lower than we thought. That's favorable. Rent is the same. Depreciation is the same. And then we have some other costs right over here. Actual is less than budget. That's also favorable. So now we can look at our total costs and we can say our total actual costs. And in this situation, we're only looking at expenses, not revenues, not income. In the real world, obviously, we'd be looking at revenues, expenses, and income. But just for purposes of explaining performance reports, we're just looking at expenses here. We have $455,000 in terms of actual expenses when we add up all these. And then we budgeted for $450,000. Actual expenses are higher than budget by $5,000. That is unfavorable. So when I used to do performance reports as a financial analyst, we would set something up like this. We'd have our actual, we would have our budget, and then we would have a variance. Actual minus budget's called a variance. And think of it as a difference. My job was to go back and figure out, why did we have this? Why did we have this? Well, you can see looking at this, this is unfavorable, and it comes back up here to these materials, right? Our materials were a lot higher than what we thought. And so we'd want to do some investigations to figure out why that is. Okay? Two more things about this performance report that I wanted to talk about. The first one is management by exception. And what that means is that we want to investigate large and significant variances. So when we look at this, this is the one we'd really want to focus on because it's $15,000 and it's unfavorable by $15,000. So this is a key variance that we would want to look into. Why did this happen? Okay, so we'd want to investigate these large and significant variances. If this were 50 cents, let's not worry about it. It's only 50 cents. It's not a big deal. It's probably not worth our time to go back through and figure out exactly what happened. Okay, so it's just not worth our time to go back and figure that out. So we want to, in terms of management by exception, we want to look at those really large and significant variances because, and the reason that we want to do that is maybe even though we had a 50-cent variance and it'd be nice to know what happened, investigating those variances takes a lot of time and effort. It used to take me a long time to figure out what happened. So we want to only spend those valuable resources on those large and significant variances. Okay, so that's one of the things I wanted to make sure that you understood about this performance report. The other one is that when we're looking at production, see how actual production is the same as budgeted production. That's important that we compare actual production on the same level as budgeted production. Let's say, for example, that this was 150. We produced 150,000 units, but we only thought we would make 100,000 units. And then all these costs are the same. What's the problem with that? The problem with that is that we would naturally expect materials to be higher. Let's say that we were making soft drinks and we made 150,000 cans of Pepsi. We only thought we'd make 100,000. Well, if we made 50,000 more cans than we thought, of course, our ingredients costs, which would be our materials, would be higher because we simply made more than we thought we were going to make more. Same thing with the labor costs. So it wouldn't make sense in that situation. So what we would need to do is to put the budget back on the same level as the actual and make sure that actual production is the same as budgeted production so that comparing these numbers makes sense. Okay? And that's something that we will talk about in future lecture videos in more detail. Thank you.